There is a ghost that haunts the portfolios of even the most intelligent investors. It is the ghost of a certainty that has died. It whispers of companies that were once the bedrock of the American economy. Names that were synonymous with stability, with progress, with an unassailable future. Names like Sears, Roebuck and Company. For a generation, to own Sears was not just an investment strategy. It was a statement of faith in the American consumer, in the inexorable march of prosperity. It was the bluest of blue-chip stocks, a titan that commanded the landscape of retail from its monolithic tower in Chicago. And then, it was gone, not in a flash of scandal or a sudden market crash, but in a slow, agonizing decline, a fade into irrelevance that punished anyone who clung to the memory of what it once was. This story, the story of Sears, is not an anomaly, it is a promise. It is the final promise the market makes to every single one of us, that any investment, no matter how dominant, how beloved, how seemingly permanent, can go to zero. And the only defense against this promise is not superior intelligence or a faster trading algorithm. It is a peculiar form of disciplined paranoia. It is the mindset that Warren Buffett has cultivated over a lifetime of watching giants fall, a mindset that allowed him to sidestep the graveyards of industry where the complacent and the nostalgic are buried. This is not about fear, it is about foresight. It is about understanding that the same forces of creative destruction that build great fortunes are also the ones that grind them into dust. Today, we are not just going to study this principle, we are going to install it as a permanent operating system in your mind. We will dissect the illusion of invincibility, the psychological trap that convinces us a company's past guarantees its future. We will explore the true nature of a competitive moat, not as a static fortress, but as a living, breathing thing that requires constant defense and is always under siege. We will build, step by step, a practical protocol for re-evaluation, a system for channeling healthy paranoia into a powerful tool for risk management. We will confront the deep-seated emotional biases that cause us to cling to our worst decisions, and finally, we will reframe this entire endeavor not as a fearful, defensive crouch, but as the most powerful offensive weapon you can possess for capital preservation and long-term wealth creation. This is the journey from hoping for the best to preparing for the worst, and in doing so, achieving a level of financial security and success that the 99% will never know. Let us begin by dissecting the most dangerous idea in all of finance, the illusion of invincibility. This is the bedrock of catastrophic loss, the sweet lullaby that sings investors to sleep just as the ship is taking on water. To truly understand its power, we must travel back in time, not to a story of Buffett's greatest success, but to the story of a company that embodied this illusion more than any other. A company whose spectacular fall from grace serves as the ultimate cautionary tale in modern business history, Eastman Kodak. In the 20th century, Kodak was not just a company, it was a cultural institution. It was a verb. To capture a memory was to have a Kodak moment. Its bright yellow and red logo was as globally recognized as the Coca-Cola script. For decades, its business model was a work of pure genius, a perfect feedback loop of profit. They sold you the camera cheap, that was the razor, and then they sold you the film, the paper, and the developing chemicals for the rest of your life. Those were the blades. This model generated obscene profit margins and a return on capital that made it the envy of the world. In 1976, Kodak commanded an unbelievable 90% of film sales and 85% of camera sales in the United States. It was a member of the Nifty 50, a group of stocks on the New York Stock Exchange that were considered so solid, so dominant, that you could buy them at any price and hold them forever. Financial advisors, titans of wealth management, and everyday savers poured their money into Kodak, believing its dominance was a law of nature. They saw a company with a brand moat as wide as the Grand Canyon, a distribution network that reached every corner of the globe, and a research and development budget that dwarfed all its competitors combined. They saw invincibility, but inside the hallowed halls of Kodak's Rochester headquarters, a quiet revolution was beginning, one that was ironically started by their own people. In 1975, a young Kodak engineer named Steven Sasson invented the world's first digital camera. It was a clumsy, toaster-sized device that captured a grainy black-and-white image on a cassette tape, taking 23 seconds to record it. When he presented his invention to the company's executives, their reaction was not excitement, but fear and dismissal. The famous quote from that meeting was, "That's cute, but don't tell anyone about it." Why? Because Kodak's entire empire was built on film. The digital camera threatened the very heart of their cash cow business. The executives, trapped by their own success, could not fathom a world without film. Their entire mental framework was built around the razor and blade model. They saw digital as a threat to be contained, not an opportunity to be seized. And this is where the psychological decay began. For the next 2 decades, they viewed the world through a lens of complacency. They saw their past success not as a result of a specific business model in a specific technological era, but as proof of their inherent, permanent superiority. This is the core of the illusion. The 99% of investors who held the stock saw the same thing. They saw the quarterly earnings reports, which for years remained strong. They saw the consistent dividend payments. They looked at the balance sheet, saw the billions in cash, and felt secure. They were suffering from a cascade of cognitive biases that made them blind. The primary psychological principle at play here is a powerful combination of status quo bias and the endowment effect. The status quo bias is our innate, irrational preference for the current state of affairs. Any change from that baseline is perceived as a loss. For Kodak's management and its investors, the status quo was a world dominated by film. It was profitable, comfortable, and predictable. The alternative, a digital world, was uncertain and threatening. So they unconsciously fought to maintain the status quo, even when objective evidence showed it was crumbling. The endowment effect compounded this error. This is our tendency to overvalue something simply because we own it. Investors who had owned Kodak stock for years, perhaps inheriting it from their parents, didn't just see it as a line item in a portfolio. It was part of their identity. It was their stock. This emotional attachment made it incredibly difficult to evaluate the business objectively. They weren't analyzing a company. They were defending a piece of their own history. And this led directly to confirmation bias, the mother of all investment mistakes. They actively sought out information that confirmed their belief in Kodak's greatness, the strong brand, the dividend, while dismissing or downplaying the warning signs. They read the analyst reports that said digital was a niche market, that the quality would never match film. They ignored the explosive growth of companies like Sony and Canon in the digital space. They saw what they wanted to see, and they paid a horrifying price for it. The stock, which peaked in the late 1990s, began a relentless, soul-crushing decline. By 2012, the company that had defined photography for a century was forced to declare bankruptcy. The forever stock had gone to zero. The illusion of invincibility had been shattered, and countless nest eggs were wiped out with it. So how do we, as intelligent investors focused on long-term investing, protect ourselves from this fate? We must adopt a mental model that actively fights against these biases. The blueprint is a technique used in high-stakes strategic planning called the pre-mortem. It is the ultimate tool of productive paranoia. Here is the step-by-step process. First, select one of your largest and most certain holdings, a stock you believe is a can't-miss forever hold. Second, sit down with a blank piece of paper or an empty document. At the top, write a headline, "Company name declares bankruptcy 5 years from today." Third, and this is the crucial part, you must now write the story of how it happened. You are not allowed to say a meteor hit or the market crashed. You must construct a plausible, detailed narrative of the company's demise. Force yourself to answer these questions. What new technology emerged that made their core product or service obsolete? Who was the upstart competitor that came out of nowhere, and what was their unique business model? Did they have a different approach to sales, marketing, or distribution? Was there a shift in consumer behavior or cultural values that made the company's offerings seem dated or undesirable? Did a regulatory change completely alter the economics of their industry? Was there a catastrophic failure in executive decision-making, a series of bad acquisitions, or a failure to invest in the right areas? By forcing yourself to write this story, you are systematically overriding your own confirmation bias. You are deliberately searching for the very disconfirming evidence your brain wants to ignore. You are stress testing the company's competitive moat from the inside out. This exercise transforms you from a passive cheerleader for your stocks into an active skeptical risk manager. The antithesis to this disciplined paranoia is the path of the 99% of investors, which is set it and forget it. This is the approach championed by those who fell in love with companies like General Electric. For a century, GE was the ultimate symbol of American industrial might, a conglomerate whose tentacles reached into every corner of the economy, from light bulbs and jet engines to medical scanners and financial services. Under the leadership of Jack Welch, it was hailed as the best-managed company in the world. People bought the stock, put the certificate in a drawer, and planned their retirements around it. They outsourced their thinking to the company's reputation. They looked at the brand, the history, the sheer size, and they saw invincibility. What they failed to do was conduct a pre-mortem. They failed to ask the hard questions. What if the complex and opaque financial engineering at GE Capital was a black box of hidden risks? What if the relentless focus on short-term quarterly earnings was leading to a hollowing out of long-term research and innovation? What if the conglomerate structure itself, once a source of strength, had become a bureaucratic nightmare, unable to compete with more focused, agile rivals? The investors who followed the set-it-and-forget-it path were the last to see the rot. They held on through the 2008 financial crisis, which exposed the fragility of GE Capital. They held on as the company shed its most iconic divisions. They held on as the dividend was slashed and then slashed again. They held on as the stock price collapsed by over 80%, wiping out decades of wealth, all because they were clinging to the ghost of the company that was, not the reality of the company that is. This brings us to the direct financial connection. How does this illusion of invincibility manifest in the numbers before the stock price collapses? The key metric to watch is return on invested capital, or ROIC. ROIC tells you how much profit a company generates for every dollar of capital it invests in its operations. A company with a strong and durable competitive advantage, like the Coca-Cola of the 1980s, can consistently generate a high ROIC, often well over 20%. This is the sign of a true financial fortress. However, when a company's competitive moat begins to erode, even if its revenues and headline profits are still growing, the ROIC will often be the first thing to falter. This is the canary in the coal mine. A company facing new competition or technological disruption has to spend more and more capital just to stay in the same place. They have to cut prices, increase marketing spend, or invest in new factories that produce lower returns. You will see this on the financial statements. Capital expenditures will rise, but net income will not rise proportionally. This slowly compresses the ROIC. A complacent investor, looking only at the famous brand name, will miss this. But the paranoid investor, the one who is constantly re-evaluating, will see a declining ROIC as a massive red flag. It is the quantifiable evidence that the moat is being breached. It is the market whispering its final promise. And by learning to listen for it, you can sell before the whispers become a scream, preserving your capital and protecting your journey toward financial freedom. This disciplined rejection of invincibility is the first and most critical pillar of a sound investment strategy. Having shattered the illusion of invincibility, we must now turn our attention to the source of that illusion, the competitive moat. This is a term Buffett popularized, but its misunderstanding is the source of countless investment errors. Most people think of a moat as a permanent, structural feature of a business, like a stone wall around a castle. This is dangerously wrong. A moat is not static. It is a dynamic, ever-changing defensive perimeter that is under constant assault from a relentless army of competitors, technological shifts, and changing consumer tastes. A company must work tirelessly, spending enormous amounts of capital and intellectual energy just to keep its moat from shrinking. This brings us to the second pillar, understanding the evolving competitive moat. And there is no better story to illustrate this principle than Buffett's most famous investment, a company he saw not just for what it was, but for what it could continue to be, the Coca-Cola Company. When Buffett started buying Coke stock in a massive way after the market crash of 1987, many on Wall Street were skeptical. They saw a company that sold sugar water. It seemed simple, perhaps even vulnerable. But Buffett saw something entirely different. He saw a multi-layered, evolving competitive moat that was one of the greatest economic fortresses ever built. The first layer was its intangible asset, the brand. But Buffett understood that the Coca-Cola brand wasn't just about a logo. It was a psychological shortcut, embedded in the minds of billions of people. It was associated with happiness, with refreshment, with America itself. It was a mental real estate that no competitor could ever hope to purchase. But he also knew brands can fade. So he looked deeper. He saw the second layer of the moat, a cost advantage. The core product, the syrup, cost pennies to make and was sold for dollars. This created gargantuan gross margins. This cost advantage was then supercharged by a global distribution and bottling network that was a marvel of logistics. A system built over a century that gave Coke a presence in more remote corners of the world than almost any government. A new entrant couldn't possibly replicate this scale. But even that wasn't enough for Buffett's paranoid mind. He needed to see that the moat was not just wide, but that its defenders were constantly deepening it. He watched how the company handled the disastrous New Coke launch in 1985. While a business school case study in failure, the subsequent public outcry and return to Coca-Cola Classic actually ended up strengthening the emotional connection consumers had with the brand. It was an accidental but powerful deepening of the moat. He watched as the company aggressively expanded overseas, using its scale and marketing prowess to build the same mental real estate in emerging markets that it owned in the US. The key takeaway is that Buffett's investment thesis wasn't a static snapshot. It was a continuous movie. He was constantly assessing, is the brand's power with young people growing or shrinking? Are competitors like Pepsi finding ways to erode the distribution advantage? Is management allocating capital wisely to reinforce these strengths? He understood that the moat was not a birthright. It was a daily battle. The underlying psychological principle that governs this constant battle is known as the Red Queen effect. This concept comes from Lewis Carroll's Through the Looking Glass, where the Red Queen tells Alice, "Now, here you see, it takes all the running you can do to keep in the same place." This is a perfect metaphor for business and competition. In a dynamic market, a company cannot rest on its laurels. It must constantly innovate, improve, and invest simply to maintain its current market position relative to its competitors, who are also running as fast as they can. Standing still is the equivalent of moving backward. This principle is the ultimate antidote to complacency. An investor who understands the Red Queen effect knows that a company that stops investing in research and development, that stops innovating its marketing, or that stops optimizing its supply chain is, in reality, surrendering its moat. The paranoid investor looks for evidence of this running. They want to see a management team that is obsessed with getting better every single day, not one that is content to admire its own past achievements. This mindset shift is crucial for effective stock picking in a world of accelerating technology disruption. You are no longer looking for castles. You are looking for the most effective and adaptable armies. To translate this theory into a practical tool for portfolio management, we can use a blueprint called the Four Moats Audit, based on the mental models of Charlie Munger. This is a systematic way to analyze and track the health of your investments' competitive advantages. Step 1 is to list your holdings. For each company, you will create a scorecard. Step 2 is to evaluate the company across the four primary types of moats. The first is intangible assets. This includes brands, patents, and regulatory licenses. Ask yourself, Is the brand's pricing power increasing or decreasing? Are its patents about to expire? Is the regulatory environment becoming more or less favorable? Rate its strength on a scale of 1 to 10. The second mode is switching costs. How difficult or expensive is it for a customer to switch to a competitor? Think of your bank or the enterprise software your company uses. High switching costs lock in customers and create recurring revenue streams. Rate its strength. The third mode is the network effect. This is when a product or service becomes more valuable as more people use it. Think of Visa, Facebook, or the Amazon marketplace. A strong network effect is an incredibly powerful moat because it creates a winner-take-all dynamic. Rate it. The fourth moat is cost advantages. This can come from superior processes, proprietary technology, or, most commonly, scale. A company like Walmart or Amazon can use its immense size to negotiate better prices from suppliers and pass those savings on to customers, creating a virtuous cycle. Rate this as well. But step 3 is the most important part of the audit. Next to each score, you must assign a trajectory. Is this moat strengthening, stable, or weakening? This forces you to adopt a forward-looking perspective. A company with a 7 out of 10 inches brand that is weakening is a far more dangerous investment than a company with a 5 out of 10 inches brand that is rapidly strengthening. This audit, performed once or twice a year, transforms the vague concept of a moat into a concrete, measurable, and trackable part of your investment strategy. The antithesis of this disciplined audit is the path of the 99%, mistaking a temporary advantage for a durable moat. The graveyard of fallen companies is filled with these one-trick ponies. The perfect example is Research in Motion, the creator of the BlackBerry. In the mid-2000s, BlackBerry was utterly dominant in the smartphone market. Its physical keyboard was beloved, its security was trusted by corporations and governments, and its blinking red light was a status symbol. Investors poured in, believing they had found the next great technology dynasty. They mistook BlackBerry's temporary lead for a permanent moat. But let's apply the 4 moats audit in retrospect. Intangible assets? The BlackBerry brand was strong, but it was tied to a specific form factor, not a broader ecosystem. Switching costs? For corporate IT departments, they were high for a time, but for individual consumers, they were surprisingly low. Network effects? This was the fatal flaw. BlackBerry Messenger, BBM, had a network effect, but it was a closed system. When Apple launched the iPhone in 2007, it wasn't just a new phone, it was the App Store, an open ecosystem that created a network effect so powerful it was like a tidal wave. For every one developer building for BlackBerry, there were 1,000 building for iOS. BlackBerry's moat wasn't just breached, it was rendered completely irrelevant. The investors who had focused on its market share and past growth, instead of analyzing the durability and trajectory of its competitive advantages, were wiped out. The stock collapsed by over 95% from its peak. This is what happens when you mistake a hill for a mountain. So how does the strength of a moat show up on the financial statements? The direct financial connection is through pricing power, which is most clearly reflected in a company's gross margins. Gross margin is calculated as revenue minus the cost of goods sold. A company with a wide and durable moat, a powerful brand, high switching costs, can raise its prices year after year without losing customers. This pricing power flows directly to the gross margin line. When you analyze a company for a potential long-term investment, you must look at its gross margins over at least a 10-year period. Are they high and stable? Are they consistently higher than its competitors? A company like Microsoft in its enterprise software business has incredibly high gross margins, because once a company is running on Windows and Office, the switching costs are immense. This gives Microsoft tremendous pricing power. Conversely, if you see a company whose gross margins are steadily declining, even if revenue is growing, that is a 5-alarm fire. It is a quantitative sign that their moat is cracking. They are losing their pricing power. They are being forced to compete on price, which is the fastest way to destroy shareholder value. This numerical analysis, this focus on the quality of the earnings, is a core component of risk management. It provides the objective data needed to validate or challenge the qualitative story of the business, ensuring your portfolio is built on a foundation of rock, not sand. We have established the need for a paranoid mindset and a deep understanding of evolving competitive advantages. Now we must translate this philosophy into action. It is not enough to simply be aware of the risks. You must have a systematic process for unearthing them, a formal protocol that forces you to confront uncomfortable truths about your own investments. This is the third pillar, the paranoia protocol, a system for rigorous reevaluation. And the most powerful way to understand why this is non-negotiable is to examine one of Buffett's own greatest mistakes, a multi-billion-dollar error that he openly discusses as a lesson in the dangers of a changing world. This is the story of Dexter Shoe Company. In 1993, Buffett was at the top of his game. He had a long track record of buying wonderful businesses at fair prices. He found Dexter Shoe, a company based in Maine that manufactured high-quality American-made shoes. The business had everything he typically looked for: a strong brand within its niche, a long history of profitability, and honest, hard-working management. He was so confident in the business that he did something he almost never does. He bought the entire company, not with cash, but with Berkshire Hathaway stock. He paid $433 million in Berkshire shares. In his own words, this compounded the error, because those shares would be worth tens of billions of dollars today. So what went wrong? Dexter Shoe had a solid moat, but it was a domestic moat. Buffett himself admitted his critical error was failing to recognize how quickly a durable competitive advantage could be destroyed by foreign competition. In the years after the acquisition, low-cost manufacturers from Asia and elsewhere completely decimated the American shoe industry. Dexter's brand and reputation for quality meant nothing when a competitor could produce a similar-looking shoe for a fraction of the cost. The moat that had protected Dexter for decades was not just breached, it was completely flooded overnight. The company's earnings evaporated, and Buffett was eventually forced to write the entire investment down to zero. This painful personal failure taught him a crucial lesson. No matter how great a business seems today, you must constantly ask, what can kill this business? His failure to apply a rigorous paranoia protocol to Dexter Shoe cost his shareholders billions and serves as the ultimate testament to why such a system is essential for capital preservation. The psychological principle that the paranoia protocol is designed to combat is the availability heuristic. Our brains are lazy. They prefer to make decisions based on information that is easily recalled. When a stock has been a winner for years, its success story is readily available in our minds. The rising stock chart, the positive news headlines, the growing dividend, these are all top of mind. As a result, we naturally extrapolate this recent success far into the future. We fall in love with the story. The availability heuristic makes it cognitively difficult to search for threats because that information is not easily available. It requires effort. It requires us to seek out bearish arguments, to read the footnotes of the 10K report, to study new, obscure competitors. A formal protocol acts as a circuit breaker for this mental shortcut. It forces you to give equal weight to the low-probability, high-impact threats that are not easily available in your mind. It is a systematic way to force your brain to do the hard, uncomfortable work of looking for what could go wrong, overriding its natural tendency to focus only on what has been going right. Without such a system, even the most brilliant investor, as Buffett's Dexter Shoe experience proves, can be blindsided by the forces of change. So what is the applied mental model? What is the practical blueprint for this protocol? It is an exercise I call the Kill the Company wargame. You must schedule this for your top holdings at least twice a year. Here is the step-by-step process. First, you assemble your dossier. This includes the company's latest annual report, investor presentations, and transcripts of their earnings calls. Second, you adopt a new identity. You are no longer a shareholder. You are the newly appointed CEO of a venture-backed startup, and your sole mission is to destroy the company you own. You have unlimited funding and the best talent in the world. Third, you hold a strategy session with yourself. You must answer a series of specific adversarial questions. How would I attack their profit center? Would I use a new technology to offer a product that is 10 times better or 10 times cheaper? Would I adopt a different business model, like a subscription service instead of a one-time sale, to steal their customers? Would I target a niche, underserved customer segment that the big company ignores? Would I leverage social media and new marketing channels to build a brand faster and cheaper than they can? Which of their key employees would be the easiest to poach? What part of their supply chain is most vulnerable to disruption? You must be ruthless and creative. Write down your detailed attack plan. The final step is to switch back to being an investor. Read your own kill the company plan. Now look at what the actual management of your portfolio company is doing. Are they aware of these threats? Are they investing to defend against the very attack vectors you just identified? Or are their heads in the sand, talking about another great quarter while you, in just a few hours, have designed a plausible roadmap to their own destruction? This exercise is the heart of a healthy investment paranoia. It's an essential part of any serious stock analysis and provides a framework for making better executive decision-making in your own portfolio. The antithesis to this proactive adversarial approach is the path of the 99%, which involves outsourcing your critical thinking to Wall Street analysts and the financial media. The average investor believes that staying informed means watching CNBC and reading the headlines. They see an analyst upgrade a stock to a strong buy and feel a sense of validation. They read a glowing news report about a company's latest product launch and conclude their due diligence is done for the quarter. This is a catastrophic mistake. Wall Street analysts are not your partners in wealth creation. They often work for investment banks that have lucrative banking relationships with the very companies they cover. This creates a massive, inherent conflict of interest. It is incredibly rare for a mainstream analyst to issue a sell rating on a large company. It's bad for business. The financial media, by its very nature, is reactive. They report on what has already happened. They will tell you about the new technology that is disrupting an industry only after it has already gained significant traction. They are not in the business of prediction. They are in the business of reporting yesterday's news. The investor who relies on these sources for their reevaluation is guaranteed to be the last to know when things are going wrong. The seeds of disruption that killed Kodak were not being discussed on television in the 1990s. They were being planted in engineering labs in Japan. The business model shifts that killed Sears were not headline news in the 1980s. They were being pioneered in Bentonville, Arkansas by Sam Walton. The paranoid investor does their own work. They read trade journals, study obscure competitors, and think from first principles. The 99% wait for the media to tell them what to think, and by then, the capital has already been lost. This all connects directly to the financials through the lens of capital allocation. After a company earns a profit, it has 5 choices for what to do with that capital. Reinvest in the existing business, acquire another business, pay down debt, issue a dividend, or buy back its own stock. Reading the statement of cash flows to see how a management team allocates capital is like reading a direct report on their strategic thinking. It is the single most important indicator of a company's long-term prospects. A paranoid investor wants to see a management team that is intelligently reinvesting capital to widen its competitive moat. Are they pouring money into research and development to stay ahead of the technology curve? Are their capital expenditures focused on building out a cost advantage? If they are making acquisitions, are those acquisitions strategically brilliant moves that strengthen their core business? Or are they engaging in diversification, buying unrelated businesses they don't understand in a desperate attempt to create growth? Or, worse, are they using all their cash to buy back stock at ridiculously high prices simply to prop up the earnings per share number and trigger their own executive bonuses? A management team that consistently makes poor capital allocation decisions is actively destroying shareholder value, no matter how good their base business is. Analyzing their choices is the financial embodiment of the kill the company exercise. It tells you whether management is a worthy steward of your capital, or if they are the unwitting agents of your investment's demise. This level of scrutiny is the hallmark of sophisticated wealth management and the key to avoiding preventable losses. We have now established that even the best companies can die, that their moats are under constant assault, and that we need a systematic protocol to monitor for decay. But there is one final formidable enemy we must conquer, and this enemy lies within our own minds. It is the powerful, irrational, and deeply human emotional pull that prevents us from acting on our own analysis. This leads us to the fourth pillar, overcoming the siren song of sunk costs. Even when our paranoia protocol flashes red, when we see the moat shrinking and the financials deteriorating, we often find ourselves paralyzed, unable to sell a stock we once loved. To understand how to defeat this impulse, we must look to one of the most difficult and wisest decisions in Berkshire Hathaway's history, the decision to finally shut down the original textile business that gave the company its name. When Buffett took control of Berkshire Hathaway in 1965, it was a failing New England textile mill. He knew it was a terrible business. The industry was plagued by foreign competition, high capital requirements, and brutal price wars. For years, he and Charlie Munger tried to make it work. They poured money into new equipment. They fought for every last customer. The business was Buffett's first love, the corporate vehicle for all his future success. It was emotionally intertwined with his own identity. But the business was a black hole for capital. Every dollar earned in the textile division was a dollar that struggled to generate a decent return. Meanwhile, their newer acquisitions, wonderful businesses like See's Candies and the Buffalo Evening News, were gushing cash and earning fantastic returns on capital. It was Charlie Munger who finally convinced Buffett of the hard truth. He explained that continuing to operate the textile business was an act of insanity. Every dollar they kept trapped in that dying enterprise was a dollar they couldn't deploy into one of their compounding machines. The emotional attachment, the years of effort, the money already spent, none of it mattered. It was all sunk cost. In 1985, they finally made the painful decision to shut down the mills for good. It was an admission of defeat on one level, but it was a monumental victory for rational decision-making and intelligent capital allocation. By killing their own past, they liberated their future. The psychological forces that made this decision so difficult are the sunk cost fallacy and its evil twin, loss aversion. The sunk cost fallacy is our tendency to follow through on an endeavor if we have already invested time, effort, or money in it, whether or not the current costs outweigh the benefits. We irrationally factor in past, unrecoverable expenses into our future decisions. I've already put so much into this, I can't quit now. This is a profoundly illogical but deeply ingrained human trait. Loss aversion, a concept pioneered by psychologists Daniel Kahneman and Amos Tversky, is even more powerful. Their research proved that, psychologically, the pain of losing is twice as powerful as the pleasure of an equivalent gain. Losing $100 feels as bad as winning $200 feels good. This is a survival mechanism left over from our evolutionary past, but in investing it is a disaster. When a stock we own goes down, selling it means we have to realize the loss. It makes the loss concrete and forces us to admit we made a mistake. Our brain will do anything to avoid this pain. We will invent elaborate stories and rationalizations to justify holding on, hoping the stock will recover so we can avoid the emotional sting of admitting our error. These two forces combine to create a toxic paralysis, trapping investors in deteriorating businesses while their capital withers away. To break free from this emotional prison, we need a simple but profoundly effective mental model. The blueprint is the zero basis test. It is a mental exercise that you must conduct whenever you are on the fence about selling a deteriorating investment. Here is the step-by-step process. First, look up the current market value of your position in the stock. Let's say it's $50,000. Second, you must perform a mental transaction. Imagine you have just sold the entire position. The stock is gone. In your brokerage account, you now have $50,000 in cash. All emotional attachment, all memory of your original purchase price is wiped clean. You have a zero basis. You are starting from scratch. Third, you must ask yourself one simple question. Knowing everything I know today about this company and its prospects, would I take this $50,000 in cash and use it to buy this exact stock at this exact price right now? If your answer is an immediate, resounding yes, then you should continue to hold. But if your answer is anything else, a no, or even a moment of hesitation, then you have your answer. You must sell. This simple thought experiment achieves something remarkable. It mentally decouples your decision from the irrelevant anchors of the past. Your original purchase price, how long you've owned it, whether you have a gain or a loss, all of it is sunk cost. The zero basis test forces you to make a clean, forward-looking capital allocation decision based only on the merits of the investment today. It is the ultimate tool for overriding the emotional biases that lead to financial ruin. The antithesis, the path of the 99%, is governed by the single most destructive phrase in the investor's lexicon: "I'll just wait until I get back to even." This phrase is a confession. It is an admission that your decision-making is now being held hostage by a completely arbitrary number from the past, your purchase price. Let's paint the picture. An investor buys a seemingly great company, let's call it Innovate Corp, at $100 per share. Some bad news comes out, a new competitor emerges, and the stock drops to $80. The investor, feeling the sting of loss aversion, says, "It's a good company, it'll come back. I'll just wait until I get back to $100, and then I'll sell." Then the stock drops to $50. Now the pain is acute. The thought of selling and realizing a 50% loss is unbearable. The logic becomes even more twisted. It's already down so much it can't possibly go lower. I have to hold on now to get my money back. Then it drifts to $20, then to $10. The investor is now completely trapped. Their capital is paralyzed, their hopes are dashed, all because they anchored their entire strategy to an irrelevant data point from the past. They didn't reevaluate the business using a zero basis test. They simply stared at their brokerage statement, praying for a miracle. This behavior, driven by ego and emotion, is not an investment strategy. It is a recipe for the permanent destruction of capital. This leads us to the ultimate direct financial connection, a concept that is simple in theory but profoundly ignored in practice: opportunity cost. The true cost of holding on to a deteriorating asset is not just the money you might lose on that asset. It is the massive potential gains you are forfeiting by not having that capital invested in a superior opportunity. The money trapped in Munger and Buffett's textile mill wasn't just earning a low return, it was being denied the chance to compound at the spectacular rates being achieved by See's candies. Let's quantify this. Imagine you have $50,000 invested in Innovate Corp. You're down 50%, so your position is now worth $25,000. You decide to hold on, hoping to get back to even. For the next 5 years, the business stagnates and your stock goes nowhere. At the end of 5 years, you still have $25,000. Now consider the alternative. You apply the zero basis test, accept the painful truth, and sell for $25,000. You take that capital and invest it in a wonderful growing business that compounds at 15% per year. In 5 years, that $25,000 will have grown to over $50,000. The difference between these two outcomes, $25,000 versus $50,000, is your opportunity cost. It's the ghost of the money you never made. Over a lifetime of investing, the discipline to cut your losers and reallocate that capital to your winners is not just a minor tweak. It is the fundamental difference between mediocre results and the kind of wealth generation that leads to true financial freedom. It requires killing your ego to save your portfolio, a trade that the world's best investors make every single day. We have now journeyed through the dark forests of risk. We have learned to slay the illusion of invincibility, to constantly patrol the borders of our competitive moats, to run a disciplined paranoia protocol, and to overcome the emotional sirens of sunk costs. It may seem that this entire philosophy is built on a foundation of fear and defense. But this brings us to our fifth and final pillar, the grand strategic pivot, where all this discipline is transformed into the most potent offensive weapon an investor can possess: capital preservation as the ultimate offensive weapon. The entire point of this healthy paranoia is not just to avoid losing money. It is to ensure that when the market offers up the opportunity of a lifetime, you are one of the few with the capital on hand to seize it. There is no more powerful illustration of this than Warren Buffett's actions during the darkest days of the 2008 global financial crisis. As the global financial system teetered on the brink of collapse, as fear and panic gripped the markets, as investors were desperately selling anything and everything to raise cash, Buffett was on the attack. In the span of a few weeks, he became the lender of last resort to corporate America. He injected $5 billion into Goldman Sachs. He invested $3 billion in General Electric. He would later make a $5 billion investment in Bank of America. He was deploying capital on an epic scale, not into risky speculative ventures, but into the bedrock institutions of the American economy, at prices that would have been unimaginable just months earlier. He was demanding and receiving incredible terms, high-yield preferred stock and warrants that would become immensely profitable. Why could he do this? Why was he able to play offense when everyone else was forced into a desperate defense? Because in the preceding years, the frothy, speculative years of the housing bubble, he had been practicing the very paranoia we have been discussing. He found very few investments that met his strict criteria. Valuations were too high, risks were being ignored. So he sat on his hands and allowed Berkshire's cash pile to grow to tens of billions of dollars. Pundits criticized him for being out of touch, for missing the new paradigm. But he wasn't being timid. He was preserving his capital. He was keeping his powder dry. His paranoid risk management during the boom years gave him the dry powder necessary to become the kingmaker during the bust. This is the ultimate payoff. Avoiding catastrophic losses is not just about protecting what you have. It's about giving yourself the ammunition to build the future you want. The underlying psychological principle that makes this possible is a mental model Charlie Munger has championed for decades: inversion. The simple idea is that many complex problems are best solved by inversion. Instead of asking, "How can I achieve investment success?" you invert the question and ask, "What is most likely to cause investment failure, and how can I avoid it?" This subtle shift in perspective is a game changer. The investor focused on achieving success is drawn to complexity, to speculation, to the hot new thing that promises rapid gains. They are constantly asking what can go right, and often ignoring the downside. The investor focused on avoiding failure, on the other hand, is drawn to simplicity, to durability, to predictable businesses. They are constantly asking, what can go wrong, and are only willing to invest when the potential downside is severely limited. By focusing first and foremost on avoiding stupidity, avoiding permanent capital loss from overpaying, from investing in bad businesses, from being wiped out in a market panic, you naturally gravitate towards the very habits and investments that lead to long-term brilliance. You become more patient, you become more disciplined, you become a risk manager first and a return seeker second. This inversion from offense to defense, paradoxically, creates the conditions for the most powerful and sustainable offense. This leads to the ultimate applied mental model, the blueprint that encapsulates this entire philosophy, the margin of safety mandate. Most investors think of Benjamin Graham's margin of safety concept only in terms of price, buying a stock for significantly less than its intrinsic value. This is crucial, but the truly paranoid investor, the one practicing inversion, demands a margin of safety in 3 distinct areas before even considering the price. First, you demand a margin of safety in the balance sheet. You must analyze the company's debt levels. How much debt do they have relative to their equity or their earnings? Could they survive a deep recession without their debt burden crushing them? A company with a fortress balance sheet, with little to no debt gives you a margin of safety against unforeseen economic shocks. Second, you demand a margin of safety in the business model. This goes back to our moat analysis. Is the company's competitive advantage truly durable, or is it temporary? Does it have multiple layers of defense, a brand, a network effect, and a cost advantage? A business with a wide, deep, and stable moat gives you a margin of safety against competition and disruption. Third, you demand a margin of safety in management. Is the management team composed of honest, skilled operators with a long track record of intelligent capital allocation? Do they think like owners? Or are they promotional, self-serving executives focused on short-term stock performance? An honest and capable management team gives you a margin of safety against foolish corporate decisions. Only after a company has passed all three of these qualitative tests do you then proceed to the final step, demanding a margin of safety and price. By building this multi-layered checklist into your investment strategy, you are systematically filtering out the vast majority of mediocre or dangerous investments, leaving you with a small universe of high-quality, resilient businesses. The antithesis of this disciplined, multi-layered approach is the path of the 99%, chasing speculative fads. This is the ultimate abandonment of risk management and capital preservation. Whether it was the dot-com bubble of the late 1990s, where people quit their jobs to day trade companies with no revenue and no profits, or the more recent manias in cryptocurrencies and meme stocks, the underlying psychology is the same. It is driven by a potent cocktail of greed and FOMO, the fear of missing out. An investor sees their neighbor getting rich on some obscure stock and feels a desperate urge to get in on the action. All discipline goes out the window. There is no analysis of the balance sheet, no consideration of the business model's durability, no scrutiny of management. There is only the price chart, going up. This is not investing. It is pure gambling, a game of musical chairs where the participants know the music will eventually stop, but they hope to get out just before it does. Let's follow the journey of such a speculator. They pour their life savings into a hot stock, fueled by social media hype. The stock soars, and they feel like a genius. They are euphoric, planning their early retirement. Then, the narrative shifts. The bubble pops. The stock crashes 50%, then 70%, then 90%. The speculator is left with nothing but a devastating loss and a brutal lesson. The relentless pursuit of easy gains, the complete disregard for avoiding ruin, is the single fastest and most reliable path to the permanent destruction of capital. It is the polar opposite of the paranoid, patient, and ultimately profoundly offensive strategy of capital preservation. And this brings us to the final and most important direct financial connection, the unforgiving mathematics of compounding and the tyranny of negative returns. The power of compounding is the eighth wonder of the world, but it only works if you let it work. A portfolio that earns a steady 10% per year will turn $100,000 into over $1.7 million in 30 years. But the real enemy of compounding is not low returns, it is large losses. Consider two investors. Investor A achieves a steady 8% return every year. Investor B has a more volatile portfolio, up 30% one year, down 15% the next. Over time, Investor A will almost certainly end up with far more money. Why? Because of the tyranny of negative compounding. If your portfolio falls by 50%, you don't need a 50% gain to get back to where you started. You need a 100% gain. A single catastrophic loss can set you back for years, or even permanently. The time you spend just trying to get back to even is time that is not spent compounding your capital forward. The entire paranoid mindset we have explored today, from avoiding complacent belief in invincible companies to systematically rooting out vulnerabilities, is designed to avoid these large, devastating drawdowns. By focusing on capital preservation, by avoiding the big mistake, You are not being defensive. You are playing the most intelligent offense possible. You are ensuring that the magical engine of compounding can work its wonders on your capital, year after year, decade after decade, creating a level of wealth and security that those who chase speculative dreams can never hope to achieve. This is the final promise, not of the market, but of a disciplined mind. You have made a significant investment of your time and attention today, and that investment has just paid its first dividend. You have acquired a powerful mental framework, a complete operating system for risk management that is used at the highest levels of finance and business. You've learned to see through the illusion of invincibility, to analyze competitive moats not as static structures but as evolving battlefields, to implement a paranoia protocol, to systematically challenge your own beliefs, to conquer the emotional biases that lead to catastrophic errors, and to understand that true capital preservation is the ultimate offensive weapon. This is no small thing. This one system, if applied with discipline, can protect you from the single greatest dangers in the investing world. But it is crucial to understand that Warren Buffett's system of thought is not a single pillar, it is a magnificent, interconnected cathedral of mental models. The paranoid mindset you have just mastered is the foundation. It is the part of the structure that ensures the entire edifice will never collapse. It is designed to protect your capital from ruin. But protecting capital is only half of the equation. The other half is knowing where to deploy that capital for maximum long-term growth. Knowing what to avoid is not the same as knowing what to seek. The skill set required to identify a decaying moat is different from the one required to identify a young, rapidly widening one. The video that is now appearing on your screen is the next part of this architecture. Think of the knowledge you've just gained as the unbreakable shield. That next video is the master-crafted sword. It contains the other half of the equation, the specific mental models Buffett uses not just to sidestep the Sears, Roebucks, and the Kodaks of the world, but to identify the next American Express or Coca-Cola in its infancy. The framework you have now is incomplete without it. The journey from being a good investor to a great one is about connecting these two powerful skill sets, the art of avoidance and the art of selection. Many learn one, but very few master both. The choice to click is not about watching another video. It is a decision about whether you are content to simply play defense, or if you are ready to complete your mental arsenal and learn to play a winning offense, building the kind of generational wealth that comes only to those who master the entire map. The next piece of that map is waiting for you. Continue the ascent.